Something huge just happened to gold, and almost nobody understands why it's falling right when fear is rising. Gold just dropped toward the $4,500 level. Silver plunged towards $73. Oil is exploding higher, and the market is now pricing a much more aggressive stance from the Federal Reserve going into this critical Federal Open Market Committee week. That doesn't make sense at first, because traditionally, geopolitical tension, especially around something as critical as the Strait of Hormuz, should push gold higher. But instead, gold is dropping. Silver is dropping even faster. And that contradiction may be the most important signal investors are missing right now. Because this isn't just a pullback. This could be a regime shift. And there's one hidden mechanism driving this move that could decide what happens next. We'll come back to that shortly. Right now, gold is trading near $4,500 to $4,600 after a sharp breakdown, while silver has slipped into the $73 range after losing key support levels. These are not random moves. They are reactions to a very specific chain of events. Let's break that chain down. First, geopolitical tension escalated again with stalled talks involving Iran. The situation around the Strait of Hormuz tightened, pushing oil prices above $100. Normally, that kind of event would boost gold. But here's what nobody sees. Oil rising doesn't just increase fear. It increases inflation. And inflation changes everything. Because when inflation rises again, the Fed cannot cut rates easily. In fact, it may have to stay hawkish longer than expected. And that is exactly what markets are starting to price in right now. Gold doesn't just trade on fear. It trades on real interest rates. If inflation rises, but the Fed responds by keeping rates higher, the opportunity cost of holding gold increases. That creates pressure. Now look deeper. The US dollar has started strengthening again, pushing toward the 98.8, 98.9 range on the DXY. That matters because a stronger dollar makes gold more expensive globally and reduces demand. At the same time, bond yields remain elevated. So now you have three forces hitting gold at once. Rising, oil-driven inflation, a stronger dollar, higher yields. That combination can overpower safe haven demand in the short term. And that is exactly what we are seeing. Silver is reacting even more aggressively because silver has a split personality, half monetary, half industrial. When inflation rises due to energy shocks, it doesn't just affect interest rates. It also raises production costs. It pressures industrial demand, and that can hit silver harder than gold. That's why silver dropped faster, falling toward the $73 zone and breaking key technical support. But this matters more. Silver's long-term story hasn't disappeared. There is still a structural supply deficit. There is still strong demand from solar, electronics, and green energy. There are still ETF inflows showing institutional interest. So what we are seeing may not be the end of the story. It may be a reset. Now let's talk about psychology. This is where most investors get trapped. When gold was rising, people were excited. When silver was breaking higher, people were chasing. Now that both are falling, fear has replaced excitement. And that shift in emotion is exactly what markets use to reposition. Because markets don't move based on comfort. They move based on surprise. Here's the signal. When something that should go up starts going down, pay attention. Because that means a deeper force is in control. And right now, that deeper force is interest rate expectations. Now we are approaching the midpoint of this story. And what silver does in the first 15 minutes after, the Fed may reveal the next 3-month trend. If silver breaks below $72 quickly after the decision, it may signal continued pressure and weak demand expectations. If silver spikes back above $75 and holds, it may signal that buyers are stepping in aggressively despite macro pressure. If gold drops initially but recovers above $4,600, that could indicate strong underlying support from institutions. If gold fails to reclaim that level, the next downside target near $4,500 becomes much more realistic. That first reaction window matters more than most realize because it shows where real money is positioned. Not just headlines, but actual capital. Now let's talk about smart money. What are institutions likely doing right now? They are not chasing headlines. They are watching flows. Central banks are still accumulating gold. ETF inflows into gold and silver have remained strong even during price weakness. That means some players are buying the dip while others panic. But here's the contradiction. If smart money is buying, why are prices falling? Because markets move in layers. Short-term traders dominate price action. Long-term investors dominate direction. Right now, short-term macro pressure is winning. But long-term demand has not disappeared. That tension creates volatility, and volatility creates opportunity. Now let's zoom out. What does this mean for the average investor? If you are only looking at headlines, this move looks scary. Gold is falling during geopolitical tension. Silver is breaking down despite strong demand stories. But if you understand the mechanism, the picture becomes clearer. This is not just fear. This is repricing. Markets are adjusting to a world where inflation may stay higher for longer. And that forces central banks into a difficult position. If they stay hawkish, metals can struggle short term. If they eventually pivot, metals can surge later. That is the game. Timing. Now let's walk through 3 realistic scenarios. Scenario 1. The Fed remains clearly hawkish. They emphasize inflation risk from energy, signal no cuts, and maintain higher for longer policy. Gold could remain under pressure and test $4,500 or lower. Silver could drop towards $72 or even below. Scenario 2. The Fed sounds neutral. They acknowledge risks, but remain data dependent. Gold could stabilize between $4,500 and $4,650. Silver could consolidate between $73 and $75. Volatility remains high. Scenario 3. The Fed surprises dovishly. They acknowledge growth risks or signal future easing. Gold could rebound sharply back toward $4,700 and beyond. Silver could surge back towards $76 to $78 quickly. But here's what nobody sees. Even if gold drops further first, that does not mean the long-term trend is broken. Sometimes markets shake out weak hands before moving higher. Sometimes the biggest rallies begin after the sharpest drops. Now let's close the loop. Why is gold falling during geopolitical tension? Because oil-driven inflation is forcing the Fed to stay hawkish. And that hawkish expectation is stronger than safe haven demand right now. That is the real driver. And that is what most investors are missing. So what happens next depends on one thing. The Fed's message, not just the decision, the tone, the language, the signal, because that will decide whether gold stabilizes or continues falling, whether silver recovers or breaks lower again, and whether this drop becomes a buying opportunity or the start of a deeper correction. So now the question is simple. Do you think this is a shakeout before the next rally or the beginning of a bigger decline? Drop your view in the comments. And if you want real macro insights without noise, subscribe and stay ahead of the move.